Today is August 6th, 2026. This economic report is on the bond market. We'll be discussing where interest rates may be headed. On top of that list is the federal funds rate. At the moment, the consensus on the street is that there's a 57% probability or expectation that the Federal Reserve Board will raise interest rates next month. That's important because before we get there, we'll look at the bond market from the 60,000-foot level. In the simplest of terms, short-term interest rates have been declining slightly, and long-term interest rates have been increasing, but again, only slightly. All that means is that the yield curve is positive, and that is exactly what you would expect. Inflationary expectations are embedded in the long bond, and those rates are increasing as you might expect. Taking a little closer look. First, there's the federal funds rate. The Federal Reserve has been stair-stepping the federal funds rate down now, since like September 2024. And for those not familiar with it, the federal funds rate is the rate banks charge each other for overnight deposits to maintain their reserve requirements. Now, right, wrong, or indifferent, it's the target interest rate that the larger bond markets all around the world use to try to figure out what the Federal Reserve is thinking. The interest rate itself doesn't do that much or anything, and you can't get any shorter than really overnight borrowing. Following the federal funds rate, the 3-month U.S. Treasury has dropped about 1.5% in the last 24 months. Those are the short rates. Next, we'll look at the longer-term interest rates, like the 2-year U.S. Treasury. And that's increased about 75 basis points since the start of the war with Iran on February 28th. Next is the 10-year Treasury. And it's gone up about the same amount, or about 70 basis points since the start of the war and with the closure of the Strait of Hormuz. The 30-year U.S. Treasury is in a little tighter trading range, but has been increasing for the last 18 months as well. If you're looking to buy or sell commercial real estate, or if you're looking to buy or sell a business, if you need help pricing those assets, go to our description box below this video and hit the more. You'll find 2 videos from our continuing education courses on how to both price commercial property and rental properties, and how to price a business for either purchase or sale. I think you'll find these educational videos of help. Having said that, if you need help, feel free to reach out. There's no cost or obligation. All in all, the bond market, much like the stock market, is absorbing the shock to the world oil supplies relatively amazingly well. Time will tell if that confidence holds. But having said that, the biggest news we've got at the moment is the federal funds rate tracker. Let's take a look at that. For the last 8 months, virtually this whole year, expectations of a rate change by the Federal Reserve have been really pretty small, which means that nobody's really expected much of a rate change or a change in policy. But that may be changing. This month is the first time this year that we've seen expectations towards a rate hike actually show up. At the moment, consensus estimates establish a 57% probability or expectation of a rate hike next month in September. Now, that's really significant in that it represents a total reversal of the trend line going back to September 2024, almost 2 years ago. Again, that's a big deal. Now, let's look at the federal funds rate at ground level. As you can see, the federal funds rate was 5.33% 2 years ago, and has been stair-stepping down to right now 3.63% today. And again, that may be changing. Now, I'm going to make an argument that if we watch the bond market closely, it'll help tell us which way the economy is going. Now, in the interest of time, to make that point, I'm going to go over this pretty fast, so stay with me. As they say, a picture is worth 1,000 words, so hopefully the graphs I show you will illustrate what I'm talking about. Here's the thesis. During the economic expansions, interest rates tend to go up, and during contractions, interest rates tend to go down. Now, let me say that again, because this is the key. During economic expansions, interest rates tend to go up, and during contractions, interest rates tend to go down. That's pretty simple. To illustrate, let's look at the federal funds rate over the last 70 years. This is a chart showing the federal funds rate going back to 1955. What it shows is that a drop in the federal funds rate has preceded every recession for the last 70 years. Next, we'll look at the 3-month U.S. Treasury. This is the 3-month U.S. Treasury going back to 1934. That's almost 100 years. And what it shows is that during expansions, interest rates tend to go up. Again, pretty simple. Next, we'll look at the 2-year Treasury. This is the 2-year Treasury going back to 1976. And what it shows is that during periods of economic expansion, interest rates tend to go up. And in periods of economic contraction, interest rates tend to go down. Again, pretty simple. Okay, what is this all telling us? Well, as I said on the onset, the federal funds rate and the 3-month U.S. Treasury have both dropped about 1.5% in the last 24 months, which again, theoretically argue that the economy has been soft or contracting. But having said that, the consensus at the moment is that it may be reversing. There's a 57% probability or expectation that the Federal Reserve may be raising interest rates next month. And that underpins the argument the economy may be stronger than we expect. But only time will tell. Until next month. Real estate brokers. How do you stay current with your clients who may not be buying or selling a property, for the next year or two? If you're not careful, they won't even remember your name a year from now. The question is, how do you stay relevant? I get it. I've been at this a long time, and it can be tough knowing what, if anything, to say when you call them, 6 months to a year from now. To solve that problem, I have for years kept in front of my clients by sending them an economic newsletter periodically. Today, we do that with, simple 5 to 7 minute videos attached to an email. I've worked with some clients for well over 20 years, using the economy as a common denominator and, point of communication. And I can tell you from personal experience, it works. In that process, if I can be of help, feel free to reach out to me. What I have found is if you do this, you'll come across as knowledgeable, experienced, and hopefully competent. And at the very least, they'll remember your name.